Hello, ladies and gentlemen. Welcome to Modern Financing. My name is Sasha Starr, and I would like to introduce my esteemed guest, Peter Bennett. He's a former professional on Wall Street, graduated from New York University. How are you doing today, Peter?
Oh, everything's good.
Okay, excellent. Fine. I'm doing well. The markets are doing well. There are some noises about that market is nervous and may go down. It might as well go up too. What's your opinion, Peter?
Well, yeah, there's always fears. Most of them are mostly unfounded. The new thing is the Fed going to cut back their tapering? Buying securities, and I don't worry about that at all. I think everybody's missing the boat here. I mean, of the long-term implications, what's really happening in the economy. Sure, they could announce it. Maybe they will do it. Maybe rates will go up a tiny bit for the short run, but the market, first of all, is really acting as if interest rates are going to stay low, and rightfully so, because everything's at an all-time high basically today, or holding around there. Nasdaq, S&P, and that's because if you really look at the realities, first of all, there's so much money out there. We're in a yield desert. Even if rates go up a little bit, they're not going to go up a lot. And there's three reasons why I have come up with now that, I've been talking about forever: energy. So, but first, actually, I want to mention, I forgot, I'm going to take a step back. This is an interesting article in Barron's. I want to just read a few sections from it. It says, dividend investors should not panic over higher interest rates. And so even if there were higher interest rates, that doesn't mean necessarily the market would tank, as everybody's so afraid of. Because in this article, they said that there were 15 times since 1950 when the 10-year Treasury yield rose at least 1.5% off its low. So that's a pretty big increase. Of course, when it was 10%, 1.5 was a lot. Now it'd be crazy because that's like doubling. But out of those 15 times, it says, during those periods, the S&P had an average annualized return of 51%. The S&P 500 had a return of 12% during the rising rate stretches. So it wasn't a tremendous boom, but 12% still is good money, and especially these days. And the reason is because that if the rates are going up, it means the economy's doing well and companies do well. So I thought that's an interesting point. So I don't worry at all if yields are going up. That said, more importantly, here's why yields are not going up a lot. And if anything, they're going to come down. I almost look at my cash and say, maybe I should lock in whatever the 30 years now, because I think it's going to be lower in a year or two. I think we're in a boom this year. I think it's going to continue. But first of all, number one is energy. Energy, by the way, has been the highest performing sector this year. I've been saying it on the show for months and months. And that's where I've been invested. I don't know, 35% in energy now because it's gone up. But energy is the place to be. And there's so many reasons why. But here's some of the reasons. One, Exxon just canceled some of their projects, or is looking at it because of ESG concerns. Mm-hmm. And that goes along with what I've said many times on the show, which is these producers are cutting back on capital expenditures. And also several pipeline companies are now shutting down pipeline projects. Because if you attack the companies and you tell them you're not going to exist in 10 or 20 years, they're going to start returning money to their shareholders rather than reinvesting it in a business people are saying it's going to die. Now, I don't think it will die in 20 or 30 years, but it's really a bet, especially if you buy a high interest paying uh, stock or MLP, that you're going to get your money back before things change. And it's probably going to be 20 or 30 years. And maybe even then, natural gas will be, usage will be higher. But so here's two other things I want to read from. One, this is an interesting article analysis. It says, at the current pace of inventory draw, we are headed for triple-digit oil prices. And this is the thing. I think people are saying, oh, what if we had $100? We could be in a bigger crisis. We could be up to 150 or higher. It says that if global demand continues to recover, and it should, COVID is going away, global inventories will decline below the 2010 and 2014 norm. So we're heading for lower than that and during that period, oil was at 140 a barrel. And it says China has been strategically draining its inventory and shunning crude on open markets, but it can't keep that up. It's been saying, oh, it's too high. I'm going to wait. And then I'll read from this too. It says, this is from the USAC report for this quarter, their presentation or financial report. And USCC, I have 5% in roughly. And this is amazing to read this and not think what it's going to do to the oil market. It says demand for all sources of energy, including natural gas, remains strong, even in the face of growing use of renewables. Demand for energy worldwide continues to outpace supply, as evidenced by the recent energy crises in California, Europe, and China. Worldwide and gas supply remains constrained due to historically low levels of capital investment. And that's what I've been talking about. It says global upstream capital expenditures averaged $320 billion to $350 in 20 and 21. And this is half the level of 2011 into 2014. And it is 25% short, according to USAC, of what is needed to hold oil production steady at 100 million barrels. So there could be a huge energy crisis. And energy acts as a tax. And people don't realize it, but when you spend more for energy, you don't spend money in the economy because you're paying for your heating bills. So I think this year, next year, we're heading for that, and that's a short-term issue. In addition, the office crisis, which I've talked to before, is looming because in New York City, last I looked now, just last month, 28% is their occupancy rate, not vacancy rate, occupancy rate. And all over the world, you have empty office buildings. This is going to cause real crisis, and the Fed is going to have to react to the crisis that way with lower interest rates. And then finally, I know there's a long piece, but this is also important, Social Security. So I read a piece today this week about Social Security. It says Medicare's trust fund is projected to be insolvent in 2026. Old age and insurance Social Security is now projected to be insolvent in 2033. 2026 is not a long time, and the amount of money is gigantic. So here's a chart of, which is going to be hard to understand totally, but this higher number is the amount that is the scheduled benefits, and the lowest amount is the amount of what they're paid. So if what they have. So this is a chart of the Social Security fund, and the disability fund, that's longer, but it'll collapse too. But look at this chart. This is your problem with the funding. We're talking about in the next 10, 12 years, that this slope is what they have left to pay. So as soon as it starts going negative, now where's the government going to get the money to pay for this in 2026? They're going to either have to raise taxes, which will crush the economy, and they could take all the money out of everybody and they wouldn't have enough. So what they're going to have to do is print money. And when they print money, they're going to have to keep interest rates zero because they can't pay interest on the money. And it's going to be a huge threat to the budgets and everything. And it's only now 2026, 5 years off. And nobody's even talking about this, hardly.
Well, let's worry about it. Donald Trump, and he will win 2024 election. He will have to actually start worrying and solve this problem, and hopefully he will be able to do it.
Yeah, I don't know if Trump will run again. I've said that before. I'm hoping actually, even though I'm a supporter of his on many issues, but not everything. I think that DeSantis, or there may be another candidate who's more likable. You know, I saw a picture of Trump. I saw it on Fox, no less. I was looking at pictures of Biden and Trump. They were showing like a montage of both of them, and I noticed that Trump never smiled in any of them. He's so grumpy all the time. And when he gives his speeches, which are delightful, you know, on and sometimes funny, he's cheery and everything. But most of the time, you just look at pictures of him standing in the White House, walking around. He just doesn't look like a happy guy, which I think reduces his appeal. And also, the media spent years maligning him, you know, as an evil person and all that. And none of this is true. He's a caring person, although, you know, he is definitely not a great communicator and has a lot of faults too. So, so I'm hoping that he won't run, and he'll be working on DWAC, which I invested in. I put a 3% in there. It's been floating around, but it's an interesting investment because that could be $1 trillion company, or it could be zero. But since it's 50-50, and I've always said, don't bet against Trump. You know, some Democrats attack Trump, and I'm not a Trump lover on all issues, but they say, oh, he had 4 failed businesses or whatever. Atlantic City went under, and his university didn't do well. But he had something like 87 businesses, and almost all of them did tremendously well. You know, and so he had a few failures. So if you look at just the odds, let's say it's 50-50. You know, let's say it's a third, and DWAC might go bankrupt to zero, or it might do reasonably well, in which case it's worth a lot more than $60 or $70 a share. Or it's a third that it goes to $1 trillion company and starts competing with Google and Facebook in the next 10 and 20 years, in which case you get, 500 times your money or 1,000 times your money. So it's a pretty good expected value on that.
Yet there are some people and financial institutions that are extremely cautious, and some of them are extremely negative about this venture for various reasons. First of all, it's unclear if and when that social media company will actually materialize and will start to perform, because right now it's all on drawing boards, or even that isn't clear whether
Yeah, we'll see. I know you were thinking of shorting it. So, you know what? Again, maybe it won't work out. But look, friends of Trump have put large amounts of money in there. You know, I know one supporter of his who he must know or whatever put like 50. I forgot what it was, but it was a good chunk of money. It might have been 50,000 or 50 million, whatever. But they put I think it was 50,000. But I'm saying he has all these supporters now that are friends, that are people who might vote for him, and he's not going to want to disappoint them. And I don't think he'll do anything ridiculous. Now, there are market forces against him, but here's the thing. Let's say he gets up a Facebook or like type company or Google, whatever. First of all, he had 100 million followers on Twitter. So if you get a good part of those people over there, that is right there. You've got a huge business. Now, you would say, oh, well, maybe people won't want to advertise. I thought about this. Maybe the big companies won't want to touch it. But in an analysis of Apple and other companies recently, I saw that even though they make money on the big company advertising, the P&Gs or whatever, who might not want to get involved politically, a huge source of revenue is small companies actually selling their goods. In other words, I need to buy a widget. I look on Amazon and I look, okay, here's, a widget, or they show a widget company puts an ad on to, a Facebook post or whatever it is. And Facebook has big problems right now, huge problems politically with so many problems with with the kids, what they've done on Instagram, and also they're going to be in hot water, even more so politically, because of what Zuckerberg did, because he financed basically Biden's election in many ways, and some may look very corrupt to me. And we won't get into that because it's a finance show, but I'm just saying, so if Facebook isn't doing well, Twitter loses a lot of 100 million people, whatever, then you've got an audience. So now all you have to do is start advertising to that audience, buy my widgets, buy this. So I'm not saying it'll fly, but I'm saying 1/3 of a percent of my portfolio, maybe it doubles my portfolio. And I'm not big in spec stocks, but in this case, I like the odds because of the expected value.
Actually, it's the only one political stock at this time where people can bet on Trump doing really well or he will fail again. So it's really nice to have a political stock where people can vote instead of looking at earnings and so on. They just basically bet with their hearts, right?
Well, if that was true, you'd have half the country putting money into their stock, in which case it would be worth a lot just on that alone. And then, it's reason. I think it's a reasonable bet. Again, I wouldn't put half my portfolio into it. I wouldn't put a third in there because again, but I wouldn't put a penny into Bitcoin. And that could do a trillion or zero also. But I don't like the odds there more. So, but one last point I want to bring out about the oil is. Uh, which I think is going to be tremendous. And that article, by the way, that talked about where oil might be going, said the oil companies themselves may go up 2 or 3 times, like Exxon and CVX, which I have stayed away with because I like some of the pipelines better because I feel like they win no matter what happens. And CVX is really leveraged. But MPLX, which is my largest holding and is about 25%. I have options on it now. I have everything. I love MPLX. They just came out with a fabulous dividend announcement and report. They not only increased their dividend by 2.5%. Now, this is a stock that was paying a 9% dividend to begin with, but now they're increasing it 2.5%, and they have a history of dividend increases still recently. But
which company is this?
MPLX.
You're kidding. Oh, that's the reason they went up again.
No, I'm not even finished.
Really
so
well.
Not only did they increase their dividend 2.5%, and they came out with a report which said now they're covering their 9% dividend by 1.6 with cash flow instead of 1.4. So they're basically earning 14% cash flow or something like that, 15% in cash flow. But they also announced a special dividend of 58 cents, which you'll be receiving, Nick, and any MPLX holders, if you're holding it on November 9th. So that's 58 cents more. So you're getting $1.28 dividend this quarter. And what they're indicating is we have so much cash because we're doing so well. Not only are we going to give the dividend, we're going to buy back shares. And I also noticed, by the way, that 4.5% of the people are short MPLX, which is the most insane bet in the universe. And that's 50 million shares. So they're going to, and I don't know what they're going to do, but if those 50 million shares, it must be the market makers who are selling options and everything because they make a lot of money on that. But those 50 million. If they're short 50 million shares around November 9th, they're going to have to pay out $70 million right there. And to them, it may be nothing because they buy and sell the options are huge, but that's a lot of money. But why would you bet long-term against this company? It's probably should be double or more. It's a utility paying a 9% dividend with growth.
Maybe that's some kind of a part of a hedging strategy when they're buying long.
That's what I'm saying.
Calls and so on. Yeah, maybe. Peter, weren't you surprised today about on CNBC they recommended selling Exxon Mobil, and they were talking about downgrading the stock.
Yeah.
Everything what we are discussing, that's quite. I don't know. I wouldn't call them wrong because on CNBC people are well prepared and they know.
Yeah. I've seen similar. I've seen some downgrades on Exxon, and that's why I don't touch it. Even though see, it's very tricky because look, first of all, an MPLX is, I believe, 80% natural gas. It's got a lot of natural gas liquids too. It's not tied to the oil market except for, I'll give you a footnote. It's the weirdest thing, but the oil pipeline. The gas pipeline and oil pipelines, even the gas pipelines move in sync with oil prices, which makes no sense except for it's probably mutual funds or ETFs or whatever who own both. And so they sell some of the other. But it makes no sense. Why would a natural gas pipeline correlate with oil prices? So today, even after this announcement of a $1.28 dividend, fabulous report. You couldn't ask for a better report. MPLX is not even higher. It's down today, and it's basically at the same price as it was yesterday before the announcement. But I mean, it's still a healthy price, but it should be up, it should be up easily 10 or 20. To me, it should be up 100% because I would hold on to it if it went up 50% because I can't get a 9% tax advantage dividend. I can't even get a 5% safe dividend just about with growth. I can only get 4% without growth. So it's tough. And the markets are not always rational in terms of making sense in the short run. But this is fabulous for MPLX, and oil and energy is just going to keep going up and up. And just like OPEC doesn't want, and China, Russia are not going to help a lot. They want oil prices to go higher. They need it to go higher. And you know what? All of them, the companies, OPEC and Russia, must be thinking, look, we live on oil, and energy. And if it's really going away in 20 years, what's our company going to look like? What's our country going to look like, OPEC, or what's our Russia going to look like if all of a sudden their oil revenues dry up? Now, Russia has some natural gas too, but that's going to hurt them big time because they're all dependent on oil. So what do? They say, well, we're not going to invest as much in capital expenditures. We're going to start taking some money off the table. You're up in Vegas and somebody says, oh, the casino is closing in an hour. You might say, okay, I'm going to take half my winnings off the table and I'll play for the last hour before I leave. so we could have, who knows where oil will go, but maybe it'll be even higher, than even 150.
Okay, let's have 1 minute break with our commercial, and then we'll continue. Okay, now let's hear from Nick Poliveda, founder of IBM TV Network. How are you doing today?
My stocks are all doing good. How I'm doing doesn't matter. It's how the stocks are doing all good, except one. I only have one loser in my whole portfolio. You wouldn't believe what it is. Kinross Gold. I'm still. I'm down 5.45 in Kinross Gold percent. Since I invested in everything else is up. The best ones, of course, is Enbridge. I still held that, Peter. I think you dumped it. And USA Compression Partnerships still held that. I cashed out a lot of MPLX, but Peter's talking me into going back in. I was just waiting it to fall to 28. It was getting real close.
It's about 31 now.
Well, it's down to 30 and change, but with that extra
30.99 or whatever. But you know what? You get $1.28 if you buy it now. So
that's right. It's like you're buying.
It brings it back down to 30 if you buy it now.
Yeah, I don't know why it went down. Also, except the climate garbage that's going on in Glasgow, oil and all this stuff.
No, it moves with oil barrels. If oil goes down $2, MPLX will probably be down. If oil goes up $2, MPLX will probably be up. It's not a rational market.
It doesn't make any sense, right? That's what I'm saying. It doesn't seem to make any sense.
Well, I think it's because, again, it's my theory that it's mutual funds or ETFs that, okay, we've got to sell some of our holdings because, oil's down or whatever. But no, it makes no sense at all. Natural gas pipelines, which make 8 and 10 year contracts for long term and run on natural gas primarily or solely, depending on the company, have very little to do with the actual price of WTI on the oil market.
Peter, I think there is a historical correlation between gas prices and oil prices. One of the factors is that a lot of oil producers, they have gas as a byproduct. And naturally, when they do oil exploration and they do development of oil properties, there is also gas in play. So somehow people accustomed to this correlation of the prices both for oil and gas, but there are two completely different commodities. And
you're half right, Sasha, and but half of it is wrong. So first of all, you're right. There is a correlation, and because there's substitutes. So let's say I'm running a utility. I can use coal if I'm willing to anymore, or I could use oil, or I can use natural gas. So there is some correlation there. Plus, natural gas liquids do correlate with oil because they're a substitute for it, and some of the gas production is NGL. What's strange is though that, well, it's not strange, but it's not known as, if oil production goes up, it actually hurts natural gas prices because natural gas is a byproduct of oil production. So they're like, okay, if we're going to drill for a lot of oil, then we'll just sell the natural gas cheap or give it away or burn it off. They even burn it off a lot of times, which
In many
is
cases,
bad for pollution because they say, well, we don't know what to do with the natural gas. We don't want it. We're not going to pipe it. We're just going to get rid of it. So if oil prices go up, it can actually hurt natural gas in that sense. But in the end, a company like MPLX, which again does, or any of the pipelines, or a USAC that sells the motors, it shouldn't have a very high daily correlation to the price of oil. That's what I think. Anyway,
yeah,
I see
and
huge value there,
if
and I
that,
see that deep value. And then back to Exxon, by the way. I mean, Exxon. If I didn't have so much in energy, I'd be looking at X and CBS, but it would be an investment. The difference is, first of all, they're oil oriented rather than purely natural gas, and I am concerned. Look, you're trying to ban oil in the next 10 or 15 years. Eventually, oil use might go down. EVs are going to run on electricity, which will replace oil, and utilities will probably be burning more natural gas or wind or solar or whatever. But so the oil markets at best maybe will stay flat in the next 10 or 20 years, maybe worldwide usage. Maybe it'll go down a little. But natural gas is forecast to go up a lot. So I'd much rather be a natural gas. And let's say you're getting a 6% dividend or a 5% dividend on an oil company. It takes, even in an IRA, it'll take a long time to get your money back. With a USAC at 12% or an MPLX at 9% and probably increasing dividends, you get your money back pretty quick. So you don't have to worry about, where the solar and wind will be, what share it'll be in 10 years, because you'll have all your money back and they'll still be running natural gas for a long time to come.
actually, speaking about of options, would you consider, Peter, a very aggressive way of dealing with MPLX, for example, as to selling long, say, 35 calls on
Yeah.
MPLX? Of course, I'm talking about puts, 35 puts, say June 22.
Yeah, you could do that, but you know what? I'd just as soon own the shares, collect my 9%, and then if it goes up, because look, this is what I'm likely holding for life. Most or all of these shares. So I need retirement income, down the road, and I don't think you're going to be able to get any retirement income in 5 years because the market will keep going up in reaction to lower interest rates. We'll have some inflation in housing and energy, but it's going to be, the market going up now is a reaction to low interest rates. But once they're going down a little more towards zero, then there's no more growth really from that. And the only growth will be real company growth. And there's a lot of issues down the road. There's the issue of technology taking jobs, and everybody's worried about jobs, unemployment. I'm sorry, lack of employees, but it's going to be the opposite. 40, in 10 years, 40% of jobs might be replaced or more by machines. These machines are very smart, as we've talked about before. Last week, I talked about CVS, where I went into the store and I went to 4 different stores because I had to buy something special. And all 4 stores, there wasn't a single person at the cash register, basically. And then in one of the stores, the nearest person was across the CVS. And the machine said, "You need help. You need help." And then somebody came over in like 2 minutes to help. But basically saying, okay, let the machines do the job. Well, these machines are smarter than people in many ways, and they're going to take more and more jobs. So this is going to hurt the economy too, even like the apartment market down the road, which right now I have some apartment REITs, but it's going to be, technology is going to be very disruptive for the economy, and also low interest rates will ultimately hurt a lot of savers. So to lock in lifetime income is my goal, and along with trading options. So if I'm going to trade options, I'd rather sell a put on a tech company, which is what I do, and we could get into the option segment since we're moving along. And I had been, maybe it was just 5, 6 weeks ago, I was talking about KLAC. And KLAC makes the equipment to make chips. So this seems like a sure bet. And
Good,
I read
good.
in Barron's, this mutual fund manager made this one comment. I said, this is brilliant. He said, during the gold rush, it wasn't the gold miners who made a lot of money. Very few of them made money. Most of them didn't do anything. What happened is Levi's made the money. So, and they made huge amount of money, and the equipment makers and everybody like that, people feeding the miners going up there did well. So I said, well, KLAC makes the equipment that all these expanding chip makers make. So maybe it was 6 weeks ago, the stock was at 350 or so. No, 325 it was at. Today it's at 380. So like happens often with my tech, I sell long puts. So I sold 23 puts at 400. And before I know it, I did very well with it, but it is catching up to my foot. So today I rolled it to 470 for 24, and actually by going an extra year out, I could keep the same basic hit point where I break even at 338, somewhere around there. So by going an extra year, but it was like in 6 weeks, boom. So I love KLAC, and also Delta looks fabulous to me. Every day I go, I should think of even doing more. I have 75 puts for 23 that I sold, very bullish. But you look at the facts there. Domestic travel is already at pre-COVID highs. Vacation demand is actually higher than it was pre-COVID because there's a lot of pent-up demand. They've added staff. They've added planes. Business travel is just starting to pick up, and it's going to pick up in a year or two. People are going to say, okay, COVID's over. I want to take my trip, my company trip. So it's all coming back, or most of it's coming back. And so Delta looks fabulous to me still with the puts for 75 for 23 that I sold.
Actually, speaking about airlines, I said it on the earlier show today that our national airline, Air Canada, they just fired today 800 unvaccinated workers
Oh, wow.
without pay, without losing all their company benefits and pensions and everything else.
Really?
So this is absolutely incredible move in a time when companies struggling to find workers, and
Seems foolish. It seems very foolish.
and there is a huge demand on air travel developing, of course, in Canada as well. And this move is a lot of people are criticizing this move, but they did it, and we'll see in the next few days how it develops.
Well, you know what? It reminds me of something else, which is interesting. It's crazy. New York City now is telling their workers that they need to be vaccinated. And a huge amount, I think it's thousands of firemen and policemen are calling in sick because they're going to go on temporary suspension. So all of a sudden you're saying to firemen and policemen, well, if you're not vaccinated, we don't want you, and they're saying, okay, well, I have tons of sick time. I'll take that first, then I'll take another vacation. But what if your buildings are burning or they already have a crime problem? It's so crazy, some of the way people think sometimes, just not business-like. And the other thing is, I'd say about that is it's so ridiculous too, because, everybody says, like in the United States, it's 70% is the rate of people who have had at least one shot now. But they never account people who have had COVID. It's like, wait a minute. How many of those people had COVID and they don't want to take a shot because they have immunity? I've seen some articles that said, one article, medical article, said that people who have had COVID are much, much more immune than people who have had vaccinations.
Not only that, it's actually counterproductive and even dangerous for people who actually were sick with COVID to do vaccination. At least they have to wait for a few months before.
Well, if that's the case, then why would Air Canada and New York City and a lot of other crazy Democrat, liberal places or whatever, not all Democrat, but generally, people think, it's, tell these people who are maybe half or whatever have had COVID already and saying, maybe take a shot, maybe it's unsafe, maybe it's not, but you don't really need it, but we're going to insist you take it. So you're hastening people to take retirements. A lot of these cities like New York City, these people have huge pensions. They might say, you know what, forget it. I'll take my pension. I'm out of here. I'm fed up with it.
Yeah,
So
I
people,
think it's a kind of exercise. I think it's exercise in a power to I told you so, just do it. However,
yeah,
in the Air Canada case, it's incredible that it's almost like a job for life. There's a huge benefits, good paychecks, or so on. And if people decided forego all that and their pensions and so on, this is. They cannot even call to take leave like in New York police department. They just sort of in a
they just walk.
no man's land. It's
Well, you know what?
cruel and unusual punishment.
You know what? But they may feel in this job market, they may say, okay, I'll just go to, Air Alaska or whatever, some other, because there's so much demand for employees right now. It gives people flexibility to say, okay, you know what? If you suspend me, I'll take my pension or I'll just walk and I'll do what I want because there's, 10 companies waiting to hire me because there's such a shortage of workers, at least in the short run, for the next year or so.
800 people. It's quite a
Oh,
number.
Nick, we can't hear you.
Okay, that's good. Facebook took us off the air for 1 week because we were discussing COVID-19. I am not kidding.
No.
They shut the whole network down for a week. They said, well, you're discussing COVID-19 and you're trying to be balanced and we don't want you. So they said you're suspended for a week. Facebook did.
Terrible.
Now we're distributing through LinkedIn now, Twitter, LinkedIn, Twitch, Facebook, and YouTube. So we lose one part of our legs, but it doesn't mean they shut us down. They just shut us down for one of our distribution links, which is Facebook. So
it's not right. We're not saying.
Hey, look. Do you want to argue with the bots? I mean, remember exactly. a lot of the decision making that's done in media is not made by a person. It's a robot who scans all of our stuff.
Yeah, and then they programs the robot. The robot is programmed.
Right. Well, the thing is, they're discussing COVID-19, then they bring somebody in, or they don't bring somebody in. They said, "Well, are they saying things that are right?" I mean, we're being reviewed constantly, so this isn't unusual. The last time we got shut down was YouTube because of copyright issues on music that was played by the artist that showed up. I'm serious. Right. This is a very controlled environment.
But to protect you for this week, let me say we're talking about the economic issues.
Oh, I know. I know.
In other words, if you're Air Canada, I'm not saying it's a bad policy or good policy. I'm just trying to protect us so we don't get canceled again.
By the time I get to somebody in Facebook to dispute it, our suspension is over with. Yeah, it just gripes me that the minute you say 19, the bots come running in like little robots. Oh, they said this thing. Holy tomatoes! We got to put them off.
Well, maybe we can't discuss COVID anymore. Maybe we should be censored on that topic.
Well, I'll let you know if we get suspended from this one.
But we all are pro shots, by the way. Obviously.
I know that, but that had nothing to do with it.
Right, exactly. We're talking about the economic implications for these companies or the
as a choice of
what it is out
choice of music for our shows. I would recommend stick to Bach, Mozart, Beethoven, because there's no copyright issue.
All the copyright issues are gone.
You can play it as much as you want.
That's true. I mean, we haven't had a problem. That was usually with YouTube. We haven't had a problem in months with that because we've been very careful on copyrights on music, so we had no issues. This thing come out was last month. One of our program guys were talking about COVID. I was going, "What?" I didn't hear anything that was unusually, in other words, that was wingnut stuff. And no, Facebook shut us down for a week. And I'm going, you got to be kidding me.
Now it's not Facebook, it's Meta. But we were shut by Facebook before this year.
Right,
yeah,
but it's Meta now, yeah.
This show is distributed to a lot of different Facebook groups like Stock Market Investor, Warren Buffett, and all this other stuff. There's like all these groups. I'll send it to you that goes to. And the groups all accept it, because when a group doesn't accept our programming, you know what I do? Get rid of the group, because there's a lot of groups out there, So we're accepted by all the groups, which is pretty cool. But because it's distributed so broadly that the bots pick it up, and the bots go, hey, these guys aren't talking about investing, they're talking about COVID, and are they saying the right things? In other words, like, we got to tell them, we got to say whatever the right things. This is the reason why that your play with DWAC is probably correct. Because the thing is, it's really hard today to get the group that doesn't violate that area, believe it or not, is LinkedIn. And we just started this year distributing through LinkedIn. They do not go do program review. They do review us. They want to know who are you that's sending it to LinkedIn. You got to fill out applications, but afterwards they don't sit and look at every program that goes through. So when this gets distributed to LinkedIn, we don't have a problem.
Okay, before we finish our show today, I would like to mention two stocks where I would recommend selling long puts. One company is PayPal. It went down big time in the last several weeks, and there is a huge weakness on that stock. It may continue to go lower, but not much because it already went down quite a bit. So I would recommend to sell long puts like June 22 at price maybe 220, or even you can sell to 200 probably, but there will be less premium. And because I'm a very greedy person, I would rather sell to 20, but it's a little bit riskier. And another one is Square, which is a well-known company. A lot of people are very bullish, but it had trying to get around over 260, went back. It's slightly over $250 now. Still has some downside probably to 230, but once a market will try to have a usually like a new year run. And by the way, we didn't discuss tax selling, but I don't think it will play a big role this time because people
No,
don't have a lot of losers.
that's true. There's very few losses in the market for most people comparatively.
Exactly. So these two
I've
companies
got
are
one stock which to talk about quickly. I know we're running out of time. I've mentioned it before, but I shifted a little bit. I had a 1/4% in AM and Tero Midstream and a 1/4% in WMB, and I moved to 0.5% on AM and dropped WMB. Higher dividend, 8.4%, 9%, 9.7% price over cash flow, so it's earning 10% dividend. It's self-funding, it's expansion. But I read the presentation of Intero Midstream, and I would have a lot more if I didn't own so much MPLX and USAC and TRP. Because I
right.
can't beat 50% energy, or 40% even. It's just too much.
Yeah.
But AM is got a 9% dividend, 8.4% dividend, and easily covering it. But what I saw in the presentation that I loved is they, first of all, by the way, they're Appalachian natural gas, which is the cheapest natural gas in the country from the Marcellus. It's much cheaper than anywhere else to get the gas out. But also they're shipping LNG all around the world to Asia, to Europe, everything. There's a chart in their presentation, which you can look up on the company website under investor relations, where they show the LNG is just pouring out around the world. And the world is short energy. It's going to be short energy. And Europe is short energy and doesn't want to only depend on Russia. So there's huge demand for LNG, and Antero Midstream has cheap natural gas to pump there. So I like it, especially in the IRA, because then I get my 8.4% back tax free quickly. 10 years, I've got my money back anyway, and I've still got the company probably paying dividends for the next 20 years after that.
Excellent idea. And we'll talk more about next Wednesday. And was Financial Show, Modern Financing. Thank you so much for being with us, and
Bye-bye.
see you all next Wednesday. Bye bye, everybody.